Good morning. I'm Tony Ash, Managing Partner of Dattilio Ash Capital Management. And this morning, I'm going to talk about the capital markets, where we've been, where we're going, and how Dattilio Ash manages investments for a typical client. So let's open up the presentation, and we'll talk about those things. There we go. So where have we been? Well, certainly over the last 10 years, the S&P 500, the index covering the broad, large cap universe of equities in the U.S., has done phenomenal. Over the last 10 years, 12.5% annualized return, which beats the long-term average of about 10%. So certainly the last 10 years have been better than the longer-term horizon. You can see that number certainly beats other major asset classes like small cap, mid cap, and real estate investment trust, the REIT market. Bonds and lower risk type asset class has not performed as well, but does serve a purpose to kind of modify the risk profile of a total portfolio. And talking about risk, you can see here this S&P 500 has been a risky asset class, a 17% standard deviation of return. That means over a year horizon, there's a very high probability that returns could be the plus or minus 17% return. Bonds are less risky, like I said, and at a good way to add ballast to a portfolio return. Though the S&P 500 has done very well over the last 10 years, it hasn't always been the winner in the asset class marathon. Certainly from 2004 to 2010, you can see the orange boxes towards the left of this chart, and that's the emerging market equity arena, including names like China, Brazil. And in the early 2004 to 2010 horizon, it was not uncommon. In fact, we did see 30% plus returns from that asset class. But if you look closely at the chart, you might say, gee, the pattern of colors almost looks random. So when Dattilio Ash puts an investment portfolio together, we're looking at all the equity sectors, small cap, mid cap, large cap, of course, international, developed markets, emerging markets. And when you put those together, you get a combination of stocks and bonds. In this particular chart, we see the green line, which is 100% stocks. In fact, the S&P 500 generated 10.5% returns over the last 15 years. When you got an 80% stock, 20% bonds, you see the red line, about 8.9% return. Then a 60-40 portfolio, the classic example. The black line is 7.5% return over the last 10 years. And if you go to the blue line, 100% bonds, much lower return and much lower risk. So generally, Dattilio Ash will only invest 100% bond portfolio for the most risk-averse client who has a short-term time horizon. One of the problems with diversification that we're a fan of is that sometimes over near-term horizons, all the asset class returns tend to be highly correlated. That is, stocks go up, bonds go up, stocks go down, bonds go down. Like we saw in 2022. That's the year when the S&P 500 was down 18% and the bond market was down 18%. Very unusual. But over a long-term horizon, we do see a lesser correlation between bonds and stocks, adding to the diversification benefit. We want to have asset classes that zig when others zag, for example. Sometimes the investment themes seem to be the compelling story, and we will look at them. But the trouble with investment themes, things like AI, clean energy, and genomics, is that you really don't know where they are in the life cycle or how long it'll take for them to become mainstream investments and generate outsized returns. For that reason, Dattilio Ash generally doesn't invest in theme type investments. We can, and we have, but it's not common. So if you would ask me where the market's going to go tomorrow, next week, next month, next year, I would say beats me. But over the long term, we do expect the equity markets to grow with the U.S. and global economy. We don't know if growth style will outperform value, if small cap will outperform large cap, or if international will outperform the U.S. market, et cetera. But we do expect bonds to be less risky than equities because bonds are bonds have a different risk profile. For this reason, for long-term investors, we do invest in a broadly diversified global portfolio of asset classes targeted to the risk tolerance of the client. This approach will capture emerging investment themes, outsized returns from idiosyncratic stock exposure, and the intrinsic variability of returns from asset classes. So thanks for watching, and I'm happy to talk to any of you regarding your investments and strategies we can implement for you. Thank you.